Freedom of time is my ultimate goal, and because of that, I highly value both productivity and efficiency. That's also the reason I use Spotify for podcasters. You see, they make it insanely easy to record, produce, edit, distribute, and do anything else I need to for my podcast right from my desktop or even from my phone if I'm on the road. I also love that they've allowed you guys, the listeners, to interact with me through polls or sharing your thoughts and experiences on the topics that we discuss. Best of all, despite them offering all these cool services, it's 100% free, and you know what? They even pay me for simply telling you about it. If you have something to share, you want to start creating supplemental income while doing limited work, and you want to buy yourself some freedom of time as well, start now at www.spotify.com/podcasters or download the Spotify for Podcasters app. Trust me, you'll love it. Hey guys, today we're going to talk about the pros and cons of having too many similar eggs inside the same basket, and why digging yourself out of a drawdown is a lot harder than you might expect. Some would say doubly hard. Now, in the podcast, I do talk about a chart, kind of a drawdown recovery chart, but I couldn't find the link of it at the time. But if you look in the show notes below this video, I will include the link so you can check it out. That way you can see, based on how much money you lose, how much you have to make in order to get your head right back up to that break-even point. All right, enjoy the show. Now, this is another good example of this is a gift and a curse, right? We always talk about developing a portfolio and why you want to have consistency in your portfolio, why when you develop a portfolio, you want to have some type of balance. Because let's say you have a portfolio of only pound pairs, pound dollar, pound Aussie, pound yen, pound Swiss, and they're all giving you the exact same move. Just because this particular move is based off of a news event that came out. If you get the exact same signal and you take all of the trades as you're supposed to, you've left yourself pretty exposed. Because you've taken 4 trades, and in this case, they're the exact same trades, there's 2 likely outcomes. There are 2 high probability outcomes. Again, in this specific type, because it is news driven. You're either going to win all 4 or lose all 4. There's no real balance in there. And those can cause big dips to your equity curve. If you're risking 2% per trade, you just lost 8% on one trading day. Whew. Where maybe if you're taking different types of trades, maybe you took 2, well, you lost 4%, but maybe you had another play on Aussie Canada at 1 and you won 3% there. So now you're down 1% instead of down 8. This was the mistake that I didn't know about at the time, mistake I made when I was trading a mechanical system. It was a trend continuation system. And by mechanical, I mean like it was no discretion, strictly rules-based, indicator-based. And I happened to get signals. I had a lot of yen pairs. I had, I think, pound yen, I had dollar yen, I had euro yen, I had Canada yen, Aussie yen. I think I had like 4 or 6 yen pairs in my portfolio because they performed good based on the strategy. This was back when, the yen was a very directional movement or a pair, because they would kind of basically say like, we're devaluing our currency and we don't care. So you just see massive moves in the same direction. And unfortunately, I had a signal and I was in all 6 yen pairs at the same time. There was a natural disaster that happened and all of those pairs tanked at the same time. And I lost a massive amount of money because of one thing. But because I had that multiplied across 6 pairs, it just multiplied my losses. Now, on the flip side, this is when I stopped trading. And if I would have kept trading, I would have won again. All 6 would have won the next week or so. But you got to ask yourself, what is the goal? Is the goal to have very big, aggressive swings in your equity curve? Big extensions and big dips, followed by big extensions and big dips? Or is it to have more of a smooth equity curve where maybe your extensions aren't as high, but your dips aren't as low? And there's no wrong or right answer to that. That's based off of, we talk about trading philosophy and personality. That is based off what you want to do, right? You can be a very high risk trader. If you want to make a massive amount of money, risk more. Have a bigger position size. And when you hit those big wins, you're going to hit those jackpots. But what comes with that is when you hit your low periods, when you hit your drawdowns, you're going to have bigger dips as well. Now, my advice would be this, especially if you're someone that's using like a money management strategy, like a smooth ratio money management strategy. The key is a consistent flow of income. And then you can gradually increase your position size as your account size goes up, right? Even if you're not using smooth ratio money management, as your account size goes up, obviously if you're risking like a set risk, like a 1% or 2%, 2% is going to have a higher monetary value. And again, it all depends on the trade, but imagine your average stop loss, whatever like that. 2% is going to have a higher monetary value when you're trading a $10,000 account versus a $5,000 account. So the goal is to slowly grow, and that way your position size grows while maintaining the same risk, essentially. Think about every time you take a big hit. Every time you take a big hit, and I wish I had the chart in front of me. Every time you take a big hit and you give yourself a massive drawdown, you've now decreased your account size by a significant amount. You've now pretty much decreased your position size if you're trading a set risk, right? You decrease your position size. So now in order to dig yourself out of that hole and get back to break even, not to mention be in profit again, you have to do more than what you did when you lost. Does that make sense, guys? If you are trading, let's say you are trading a $10,000 account, and we'll just keep the math simple. You're trading a $10,000 account, you're overexposed to whatever, and you lose 50% of your account. Now you're down to $5,000. Would you guys all agree that if you're keeping the same risk, your position size shrinks in half, right? 2% of a $5,000 account is half of 2% on a $10,000 account. Right? So it was very easy to lose that 50%, to lose that 5,000. Now, in order to get back from 5,000 to 10,000, you have to double your account. We can all agree with that. The hard part is you have to double your account while trading half your normal position size. So you have to do double to achieve the same. There's a cool chart. I wish I could find it for you guys. It's Stephen Burns shares it every once in a while. It's a mathematical chart that shows you based on your drawdown how much you actually have to achieve just to get back to the level that you were at before your drawdown. And it's amazing because we don't think about it. We just think about like normal drawdowns without changing our position size, where it's like, okay, if I lose 5,000, I just take the next trade and I'll just have to gain 5,000 back. Like, no, it's you have to do more work. And the hard part is you have to do more work while ideally sticking to your rules. And your rules are probably not meant to have these big swings because, ebbs and flows, right? Extensions and pullbacks come naturally. You have your period of drawdown and you have your period of extension. You have your period of drawdown and you have your period of extension. You're not necessarily your strategy isn't necessarily gonna change. You're not just gonna catch fire because now you have to dig yourself out of a hole. You're not just going to become a super trader because you hit a drawdown. You can't just flip a switch and be like, okay, I'm going to win my next 20 trades in a row, right? Because if that was the case, you would do that in the first place. So what happens is traders getting stuck in this negative loop of they have a bad drawdown usually caused by some type of dumb mistake. Because if it wasn't a dumb mistake, you probably wouldn't have that bad of a drawdown. You have a bad drawdown caused by a dumb mistake. You then try to trade your way out of that drawdown, and you hit a little bit of a hot streak. But you realize because your position size is cut in half and your drawdown so big, your hot streak doesn't get you to where you were at before the drawdown. And now you get frustrated because you're winning, but you're still in a drawdown. So what do? Well, you try to do more. You either force trades, you change things, you increase your position size. You do that after your hot streak is done. And after your hot streak comes your losing streak. So you're doing all these more mistakes right when your next losing streak comes, which pushes you even further down the hole, which makes you feel like you have to do even more to make up for it, because now you don't have to make up for the first drawdown. You got to make up for the first and the second drawdown, right? It's like credit card debt, right? You use up your limit on your credit card, so what do? You get a new credit card. You do a balance transfer. Well, now you got two credit cards that are loading up on debt. What do? Well, you do a third credit card to free up that first one. Well, now you got three credit cards that are loaded up on debt. And you're digging yourself in a deeper and deeper hole, and that hole gets harder and harder because each credit card you acquire, you're loading it up with the debt of the previous credit card, which means you're getting hit with these fees and these interests. And the more you have on that credit card, the bigger the interest is, which means the harder it is for you to pay it back. You're just making your situation worse by taking on more credit cards and more debt. You're trying to do something that you think is going to make your situation better, but it's actually making it worse. So those are the issues that people get into when you have those big drawdowns and you're unable to get out of them, and you try to look for the quick way out of them. But the cause of that is also a lot of, well, not just the mistakes that you make during it, but overexposure. So when you're creating your portfolio, you need to make sure that there's balance. My opinion, instead of having, this is my personal trading style, instead of having the big extensions and the big dips, I would much rather have a steady curve, because the thing I want to avoid is drawdown. I want to avoid big drawdowns more than I want kind of big profit boost, because I know that as long as I'm steady, as long as I'm not taking big drawdowns, I can steadily and consistently increase my account size, which means I can steadily and consistently increase my position size, which means I don't have to worry about going backwards. I may be slowly inching forward, but I'm never really going backwards. And as long as I'm going forward, I'm on the path of making more and more money. And that's my ultimate goal. Make that profit, baby. So if you're dealing with drawdowns and you're not sure why or how to stop that pattern from happening, there's a good chance that there is some type of mistake you're making or some type of obstacle that is standing in your way of success. If you're looking for some coaching and some support to clear that obstacle, look no further than www.tier1trading.com. We've been doing this for a very long time. We work with traders of all different levels, from brand new noobs to experienced traders that are just kind of stuck on one little thing. So check us out, www.tier1trading.com. I recommend the risk-free trial membership. That way you can get on the platform, talk to the community, check out our resources, check out our trading styles, and make sure we're the right fit before you make any type of investment. www.tier1trading.com, and I'll see you there.